Thank you, Sherlock, for joining me today. So, how old were you when you first started investing?
So, this will date back to February 2018. So I was turning 19 years old, and wait, let me do the math right. Yeah, I was 19 years old, and it was my birthday, February 3rd. So I was like, well, let me date back. So going into Thomas Nelson Community College, right? That's my alma mater. That's my first alma mater. I came across this YouTube video, right? It was like, how do you get out the rat race? I was like, what's the rat race? You know what I'm saying? Working at Journeys, making minimum wage, that's like one of the first jobs I ever had. So I was like, it's not the best money, but it's something I can do, right? So when I looked at this video, it was talking about how, people can work, 9 to 5 for their whole life and they're like, miserable and then, not really following their passion, things of that nature. And like, they don't have time for their family. I was like, wow.
Dedicating their whole life to a 9 to 5. That's
Yeah. And
just
unfortunately,
pennies.
I see that throughout my life, with my family structure and stuff like that. And I was like, I don't want that for myself. So I was first introduced to investing at the age of 18, but I studied, the markets, I studied like what is a stock, what is a bond, how do you invest? And then I put my first like $100 into the market on my birthday, February 3rd, 2018. Yeah.
Did your family ever talk about money around you growing up?
If it well, yes, but in a bad way. I grew up with a negative connotation on money because grew up single mom, low income, didn't live in the ghetto, but it wasn't the best place to live at. We had to move out because, there was water that was flooding our house. So thankfully we moved, to a place in Hampton called Elementary. So throughout that whole, way of childhood, I always heard about money in a negative light because again, I came from a low income single mom, they have the world against them pretty much, there's not a lot for them unless they're unemployed. Thank God my mom wasn't unemployed, but she was a teacher, teachers, again, don't make that much. And, it was only me and her. We had we have a great family and everything, but still, it was only me and her. And, we try to make the best of that. And whenever I hear her talk about money, she might, unfortunately, she might cry. She might, be like, I wish your dad was here to help me,
It's
but
kind of a
he's
sensitive
not.
topic.
Yeah. But so I always grew up with that, but I knew, she was strong. She pushed through it. She didn't make not mistakes. She didn't make excuses to like hold her back from providing for me because she always bought me every Lego set I wanted. Always, I grew up with Legos. That's how I'm an engineer now. And, she just never made excuses, to push her back. She never became rich financially, but she became rich spiritually. So that was really pushed me forward as a man before I started getting into investing. So all that to say, I grew up with a negative connotation on money. Yeah.
Why is it so important for Black people to understand financial literacy?
So, first of all, this is a big question. We have to go to the foundation on why it is. So I wanted to say this, a couple things about that. So to start, I want to say all people, no matter what background of life, need financial literacy. Financial literacy is the foundation of building a productive handle on your income, savings, and investing. Once this productive handle is set, keep growing it because this is all about learning from implementation, just like all things in life. The number infinity, not number one, but number infinity rule to financial literacy is to never hold this knowledge away from your family, away from your friends, and away from the public. You will never grow financially nor spiritually if you don't give. Give your time, energy, and resources to others. And while you're giving, keep planning so you can give more in the future. And I come from a spiritual background, Christian, God first. So Proverbs 21:5 says, "The plans of the diligent lead to profit, as surely as haste leads to poverty." So all of that, right? The foundation builds onto what I want to go into with the history of African American economics. So if you think about what we learned in history class, not everything, unfortunately, but we as African Americans, right? We're Africans first. We came from Africa. And even though in Africa we were, some of us were slaves at that time, we're still living with our people. We weren't abducted, we weren't, separated from our people. We're in our motherland. So once we're separated, we're in this place now called America. And how they used us was through slavery and by leveraging us, right? That was our first economic theme within America. So when we're leveraged, they were using us as credit, right? So how you have a credit card now, that's how a slave was used. They're used as collateral so they can buy land, so they can do gambling, at a parlor, so they can buy houses, So with all that being said, the system was already rigged against the African American. And then with that, right, after, Reconstruction, after a slave or African American isn't considered 3/4 of a person, now they're considered a full human. Going into the early 1900s, we had a thing called Black Wall Street, right? So Black Wall Street, it was in Tulsa, Oklahoma, Greenwood District. So they had at least from 70 businesses up to 600 businesses, from airports to hospitals to barbershops to, mailmen, anything. All the business that you see here in Hampton, Virginia, they had it here in Black Wall Street. And it was all tore apart, it was all tore apart. That was the first significance of Black wealth within America, somebody that's Black, that's an entrepreneur, that's growing their own land. Growing their own produce on land, owning their own land. They don't have to own slaves to run this. Everybody was doing legit business. It was all tore down because, of unfortunately jealous Caucasians, and it was wiped away. Nobody went to jail for it. No, the city didn't, get fined for it.
Kind of independently wealthy?
Yeah, independently wealthy. Yeah, and we lost that in history because we never learned that. We never learned that in school. We were finding this out like 2 years ago, and now we're just now actually making it a thing this year, actually. So, and then with that, I just want to say that from that point, so that was early 1900s, through the 20th century, our people have been surviving, not building, but surviving. They have always been in this mindset of surviving. We have to, get to the next day, So when you're building wealth, when you're learning financial literacy, it's all about not just tomorrow, but it's about what can we do in the next year? What can we do in the next century? What can we do in the next millennium? How can we build generational wealth? But unfortunately, we were put behind.
It's kind of like they're breaking even, but there's no extra money to the side.
Yes, there's none whatsoever. And and again, even through the 20th century, even when African Americans, were in that state of surviving, even though some of us are still in that state of surviving, some of them did have real estate. Grandma did have, some real estate, in the ghetto. You know what I'm saying? Grandma did have some real estate somewhere else, or your grandfather, right? But unfortunately, because there's no financial literacy throughout the 20th century, when she passed or when he passed, the grandmother, grandfather, the grandchildren didn't know how to use it. They didn't know how to leverage real estate. They didn't know how to, use that as, use it as rent, or, there's no backing of financial literacy that came from the grandparents or that came from the parents, because they were always surviving. They had a house, but they didn't know that they can use that house to, make money off of it. They're just paying the mortgage, paying the rent, So, and I feel like that's where we're at now. But now, because of social media, I really give a big kick to social media. Even though people say social media is bad and get off of it, because of this phenomenon with social media and how we're using it as just African Americans. I'm not talking about anybody else, just African Americans with memes and, just relating to each other. We're talking about financial literacy and how we can change how we used to be, how our generation used to be, how our ancestors used to be. And now we're putting a new name on it. We are Wall Street now. You know what I'm saying? We can own land. We can own real estate. We can own stocks. We can use credit in a good way. We can use debt in a good way, things of that nature. So With financial literacy, it's a lot, but it all starts with the mindset, right? So I was talking about, you know, surviving. And now that we're in the 21st century, I believe that we can switch that mindset now towards owning, and building, having ownership of what we have, I'm not talking about clothes. I'm not talking about shoes, not socks. I'm talking about owning a house, owning land, owning stocks, doing everything that the other races do, right? But in our own way. We have to, make it culturalized, just like everything else. And mind you, right, I didn't even say this, but when we were surviving throughout the 20th century, the other race were taking up the land, were taking up the real estate, because African Americans, they have money to buy real estate. They have money to rent and stuff like that, but they couldn't buy the real estate that they're rented out. So, Caucasians and Asians, they're owning all these different, pieces of land and pieces of property throughout America, from the east to the west coast. And throughout the years, the real estate market now is on fire. Where do you think that came from? That came from all the building, all the buying that was going on throughout the 20th century, even throughout the beginning of the 21st century, before and after the recession. Because people need houses. I mean, that's regardless. People are going to have to live in a house, regardless. So, and African Americans barely got any of that action, even with the stock market, barely got any of that action.
Now,
So,
I have a quick question. Do you believe our generation, if you want to call us millennials or Gen Z, you know how that borderline is, do you believe some black people don't know the value of a dollar also, and that they, how should I say this? They're impatient with their money? When I mean impatient with their money, let's say $500 is right here. You may invest that money. They may go buy some shoes with that. Do you feel like they don't want to be in it for the long run?
yes. And it all dates back to that survival thing, right? Because once you're in that survival mode, right, that mindset, you're fighting or you're flight, or you just froze, it's, if you know like how the brain works, you have those different things, right? You're looking around your surroundings. You're looking at what everybody else have, right? And you want to match that. And, that's human nature. You want to look as good as somebody else or even better. So unfortunately with African Americans, we went through the culture of, rap. I feel like rap and hip hop gave us that culture of, we have to stunt on everybody, so it's not,
It's
we
always,
never
I got
promote
one
it.
of these, you ain't got one of these.
Yeah, exactly.
I see it
like
all
we
the
want to
time.
watch, but we never talked about like how about we own a house? Like maybe I own a house that's a little better than yours, so you should buy this house. Like we should compete like that, not compete with like liabilities. Because we want assets over liabilities. So to answer your point, I think the reason why African Americans don't see a dollar, the value of a dollar, the same as other race, is because we just don't have the education there. And we never, and again, from that surviving tactic, we couldn't have any education. The system was not built for us to have education because we came here as a slave. They destroyed what we have. And then when we were surviving throughout the 20th century, we couldn't go to libraries. My grandma could not go to a library. She was working at a hotel, just helping people like put their rooms together. She didn't have time to go to a library to learn about the stock market where it was at in the 60s.
Probably long hours, low wage, and trying to survive.
Yes. And she was growing, not just my mom, but, I have 3 uncles and another aunt, so her sister. So that's 5 children, She didn't have time, to take, to put, discretionary research into what real estate was in her area or what the stock market was at, where the S&P 500 was at when she was, living in the 60s and stuff like that. So I think that's why just the education, the history is missing, because even African Americans, we don't even know our own history really, like what is an African American, you know what I'm saying? But I'm not going to get onto all of that, but we're just talking about money. So
You did something I have never seen anybody. I think you were 21 when you did it. So you bought your lady some stocks or some investments for her birthday, correct?
Yes, I sure did. Yeah. So this is for her birthday. So March 23rd, 2020 was when I bought it. I bought Louis Vuitton.
Something nice, of course.
So nice, right? I mean, 'cause, usually people or a man, buy their woman the Louis Vuitton bag. I don't even know how much they are because I don't track all that. I track the stock price. I don't track the.
It's enough to put a dent in my account.
Yeah, yeah. So I bought her Louis Vuitton, bought her Amazon, right? And this is all fractional shares. So I'm not buying because Amazon is worth like $2,000 per share. Well, it was at that time. I didn't buy her a whole share. I bought her like fractional. So Louis Vuitton, Amazon, Apple, and yeah, those are the three. So I just want her to own the, three best. There's some of the three best companies in the world. Greatest companies that'll ever exist. Louis Vuitton. Like when would they ever go out? Too many people. And I'm just saying African American. Yeah, I'm not just saying African American only own it, but not own it, but buy it. Not only African Americans buy it. People in China, they love Louis Vuitton. They love Bape. No, I say they love the brand. So they're never gonna go away. And actually the third richest man, Sir, do you know his name? Sir Richard Vaillant, something like that. He's the third richest man in the world, and he's the maker of Louis Vuitton. So you got to look at who's the richest in the world, right? Bezos, Warren Buffett, Mark Zuckerberg, the dude that owns Louis Vuitton. What do they do, and what companies have they made? And you need to ask yourself, can I own those companies? And I say yes, you can own them. They're easy to own. Just use that money that you're about to, use on your lady or use on yourself, unless you're about to use it for a productive reason. But if you're just going to buy them clothes and stuff, buy the company that owns those clothes. If you're going to buy Nike, buy the brand. You know what I'm saying? So that's how I feel. That's how I move in life. Like if I'm going to actually own the shoes or whatever clothes or the brand or whatever, I need to own the stock first before I buy the liability. So yeah. So to answer that, okay, $55. No. It was at $57 when I bought Louis Vuitton in March of last year. Since then, now it's $162 per share. Yeah. And let me do another one. Apple. When I bought Apple for her, it was at, and now Apple did a stock split, right? So it wasn't the exact price of what I bought it for during then, but it was at $53 when I bought it for her. Now it's at $130 per share. And then Amazon, again, this is fractional shares. I didn't buy the whole, thing for her. So, but in the future, I will. That's the goal. So when I bought Amazon for it was at around $1,700. Now it's at $3,479 per share.
Now, I noticed some people consider stocks and trading as high stakes gambling. Mm-hmm. But can it be used as savings too?
Yes. So it can be used as savings. So, so the background of the stock market, right? We have the Dow, we had the S&P 500, we had the NASDAQ, right? The Dow holds 30 of the best companies in the world. Well, not really in the world, but in America, right? The 30 best blue chip stocks in America. S&P 500 hold the best 500 blue chip American stocks that's in America. So in that index, right? And then the NASDAQ holds technology stocks, right? I don't know the specific number for how many the NASDAQ holds, but they hold the best technology stocks that's from America or around the world. So it's not gambling unless you're just looking at the price. So let me get into that, right? So my background in stock investing comes from fundamental analysis, right? So fundamental analysis, you have to look into the financials of the company, right? You have to look at the balance sheet, the income statement. You have to look at the cash flows, right? You have to look at who's the CEO, what's the management, what's their forecast for the future, what can they do better for their business, right? So when you put all those things together, right, you're not just basing everything off of a price, you're basing everything off of what's going to happen in the future, right? Because you're looking at how much cash do they hold on hand. Because if this company, right, like Apple, they hold over $100 billion in cash, right? And their debt to cash, I think how much debt do they have? I think they have 60 billion in debt. So you already see that, their cash outweighs their debt, so they can pay that off and still have like another, 40 billion or even more on hand, right? So you're investing in a company that can sustain itself whenever it might fall down, like being in a low spot, right? Like with the COVID-19 pandemic. Apple didn't rise just to rise, right? It rose because it was beating its earnings. It was delivering more onto its customers than ever before. It was coming out with, great products like, everybody owned the AirPods, everybody loved their Apple Watches, everybody is anticipated for the Apple car, Apple car. Like we never thought there would be an Apple car, but Apple is really the next conglomerate, right, of this world. They want to own everything. So by just knowing that about Apple, it's like, okay, do I just want to sit back and just let them own everything and me not get a piece of it? Or am I actually going to put my money to work and let the money work for me and actually invest into their company, right? So let me back up one more time. After you get the fundamental analysis done, right? When you look at the cash flow statement, look at the balance sheet, look at the income statement as I do, and look at, okay, how good is the CEO and the management? Then that's when you want to look at the price, right? That's when you look at the price. So if you see the price is high, don't buy it yet. So a high is the 52-week high. If it's around that 52-week high, and that's a year, so within that 1 year high, if it's around that, if it's around that multiple, right? So if the 52-week high is $100 and Apple's at $100, don't buy it, right? It's really that simple, right? And you have to have discipline. You have to have patience for this, right? Just don't buy Apple. Even though we know it's a conglomerate, we know it's about to own everything that's around us, don't buy it yet.
I remember you said there's some psychology into
there's some,
stocks.
yeah. And that's because the stock market is psychology, right? The stock market is discounted to how do a person see that business, right? So like for me, right, I'm in the stock market. So I'm a part of people that that bought the stock and the price is shooting up because of us buying the stock, right? So my emotions, my belief is within that price. So to some people, right, they might see $100 for Apple. They're like, oh, that's too much. So they sell the stock. But then somebody might see $100 and be like, oh, that's too low. They're undervalued, right? So then they're going to buy the stock. So when you know that, when you can see the emotions within the stock price, right, you can gauge where the market is going to move, because market is just people buying and selling. That's just economics in general, demand and supply. So
now when it comes to stocks, can you explain selling versus trading?
Yes. So selling versus trading, selling as in like us just like buying it and then just holding it.
Yes.
Okay. Yeah. So buying and hold instead of like just trading, right? So that would be long-term investing versus short-term investing, right? So let's back up and talk about it. So buying and hold, right? So let's say I just go into the market, right? Because the market's not going to force you to buy something. You have to tell yourself, like, yes, I want to buy this stock. Yes, I want to own this company. So yes. So then you make out a plan. Okay, I'm going to buy and hold Apple for 10 to 15 years, right? So I buy it at this price and I'm about to hold it no matter what happens throughout that 10 to 15 year span, right? And that's depending on the person. But so that's buying and holding. Just buy it one day, 1 year. Maybe you might accumulate more throughout those years, but then you might sell it later on in 15 years and you get a tax, advantage from selling it more than a year away, right? But with trading, short-term investing, so if you're doing options or futures, right? And mind you, I don't do options and futures. I will get into that, later on in my career of investing, but right now, I'm just like, I just want to build my long-term account, right? So, but for short-term investing, right? Now that part of the market can be gambling if you don't know what you're doing. So again, with the education part, right? And definitely when it comes to us, with African Americans, we know that we see on social media, people are like, oh, I made $1,000 today off of options. Oh, I made $500 off of Forex. I made, amount of money off of doing futures, right? That's good, but it's like, how much time did he put into that, right? It takes time, it takes education, it takes patience to actually make a buck, just $1 off of trading, right? You have to go into what's called technical analysis. And I wasn't really going to dive into this because I felt it's more advanced for people that don't know financial literacy yet. But technical analysis, you have to look into theories like Elliott wave theory, right? That's made from the early 1900s or so, or from the 50s. The Dow theory that was made in the 50s, right? Like smart mathematical people that were analysts on Wall Street or analysts somewhere else in America. You have to read. You have to read. Even with long-term investing, you need to read. But definitely, if you want to get into trading, you need to read. And people in America, all in general, I would think majority of us like to read. That's why we voted. That's why people voted for Trump. Nobody was reading. Like how bad he was and stuff like that. But it is what it is. But with short-term investing altogether, I feel like it can be gambling if you don't know what you're doing. And that too, with long-term investing, if you're investing into the wrong companies, that's a gamble. But if you research and have the conviction that it's a great company, then that's not gambling. That's building your thesis, right? So it's a mindset thing, right? Because to somebody that's just look at the stock market and just say gambling, they're going to say everything's gambling, right? Just because a stock went up or a stock went down, they're going to say, oh, see, that's what you get for gambling or whatever, right? But when you have that education and you know what to look for and you know what to do and you know what to wait for, then it's not gambling. It's being premeditated. It's building, like I said, a thesis. It's having a plan. Because like that Proverbs verse I just read, you need a plan if you want to make profit. You need a plan where you're doing trading. You need a plan where you're buying stuff. And this is not just in the stock market. This is with everything in life. With credit cards, you need a plan. With going to school, you need a plan. When building a house, you need a plan. When finding great land, you need a plan. When finding a spouse, you need a plan. So you need a plan in everything. So, and I really feel like the stock market, can even help people with that, like building discipline. 'Cause I feel like it helped me with that, right? Like just waiting, buying a company, waiting for it to get to a certain price that I would want it to get to, right? Or, just waiting for it just to get higher, right? I'm just like, wow, it takes discipline and patience to really see this happen. And you have to be a visionary for this too, right? And that's in all things in life. You have to be a visionary. You have to know that something is going to, be good for you in the next day or the next year. Things of that nature. So, but I'm not gonna go on a tangent with all of that. So, yeah.
So, obviously, our generation has a lot of single mothers, or basically kids raising kids.
Yeah.
What are some of the first steps you think they should take to start saving money?
Yeah. So, this is a great question. So, I feel like the best thing to do is to build a budget. You need to have a budget. So, we're talking about stocks and, trading, things of that nature. You need to have a budget first before you even get into any of that investing. Because investing is something that you want to, that's for things in the future. So you want to do things that's now for your budget, right? So if you're a single mom, or if you're just not in the best spot, right? If it's just you or you're...
There's no support. It's just
no support, right? So you need to have a budget. So I do what's called 50-30-20 plan, right? So, well, not just called 50-30-20. It's called the pay yourself first 50-30-20 plan, right? So, and the reason it's named that is because when people get their check, what's the first thing that they put that money to, right? Think about that. What's the first thing, when somebody get their check, what's the first thing that they do with that check?
Well, I ain't gonna lie to you right now. I pay my bills with it.
Yeah. So, and that's the thing. So you're paying your bills, you're buying some clothes, right? And nothing's wrong with that because you need to be a good Samaritan and pay your taxes, pay your bills, take care of your family. That is key. But then you're like, okay, at the end of the day, like, where's my money, right? Where's the stash? Like, where's my emergency fund? Things of that nature, right? So we're paying everybody else and we don't have any left for, the ground, the foundation. So to pay yourself first is when you get paid, you take a certain amount out first and put that to an emergency fund for, a rainy day or, just anything that happens, right? That's paying yourself first. That's building that confidence, right? 'Cause you need confidence in financial literacy. You need confidence with having a great financial future. Because if you want to have a long-term vision, you need to build the things you're doing in the short term, right? You need to build a confidence you're doing in the short term. So I say you need a budget. So how it works is that you pay yourself first into an emergency fund. For me, I take out between 300 to 500 each check, and I put that to my own emergency fund for, again, a rainy day. And then after that, that's when I start allocating, right? So 50%, after I take that, pay yourself first out for emergency fund, I take 50% of my check and I put that towards necessities. Like you said, for bills, like housing, if I'm helping my mom with rent or whatever, groceries, because now I'm starting this new diet. So now I'm buying my own groceries and stuff. So different things and et cetera, whatever the person thinks is a necessity, because everybody have their own, background to life. Not everybody is a college student. Not everybody is a single mom. Not everybody is a single dad, things of that nature. So whatever is a necessity to you that has to be paid, put that towards a 50%, right? And keep it there. So 30% goes to your wants. So entertainment, eating out, clothes, the brands I was just talking about. If you want to buy you some Louis Vuitton, you know what I'm saying? That's a want. That's not a necessity. We need to switch the mindset. You wearing Louis Vuitton and showing out, that is not a necessity. That's a want. You paying for, your children's tuition, that's a necessity, right? You need to put that first, put your children first, keep them in the 50%, right? So, and then boom. So again, like wants, that's 30%. Allocate that away, 30%, right? And then 20% is to the investments that we were just talking about, real estate, land, stocks, cryptocurrency, whatever you want to do, whatever, gives you that itch, like, okay, I just want to invest in this, right? And make money off of that. Put that 20% towards that and keep it there. So, and this is what I did, starting in 2018, I started my own budget then. Again, I was minimum wage, by the time it was the end of 2018, I had 2 jobs. So I was making $7.50 an hour at Journeys. And then I was making, $9 an hour at Thomas & Nelson. But I didn't let that deter me, so I was starting with, $50 going into the market to my into my 20% investment, $100, $200, sometimes maybe if I get lucky, you know what I'm saying? But then I was also being responsible and disciplined to that 50 and 30%. So I was, it's about building that discipline and that responsibility and having that vision. Because my thought process was, it's not always going to be like this. Like I'm going to become an engineer and I don't have to, scrounge money, because I want to put more than $1,000, each week into the market. That's my goal, every day, that's really my goal. And then, so let me deviate back from that. The key with this budget of paying yourself first with the 50, 30, 20 is that, so you could switch that 50% that you had towards your necessities, and you want that to put into investments, right? Because the goal of financial literacy is to build and to multiply, right? So you need your money to work for you at an even greater rate, right, than just putting 20%. So right now, with me, I was so disciplined, I was so, hands-on with my budget that now I allocate 50% of my income towards investing, and mind you, like, I'm in college and stuff, so.
When you say investing, do you mean saving too?
Yes. So, I'm sorry. When I say investing, I do just mean like just putting it in stocks and like maybe finding different alternative investments. The saving part is just with the pay yourself first, that emergency fund, right? So I just keep that emergency fund, let it build and let it, collect the bank account interest, whatever it has. That's my only savings that I have, right? Because with the investing, that's like where my money actually starts to triculate. And then like, once it starts trickulating and stuff like that, then like if I want to, I could pull it out and start using it on different things if I want. But I don't do that because long-term investing and stuff. But I mean, to each his own. It's for, it depends on the person. Like, you can have multiple savings accounts, but I would say, keep it all. If you're gonna make a savings, just put it all in one. Just have it stacked up in that one savings, because sometimes too many accounts can lead to confusion, and it it can lead to anxiety. You don't want anxiety when you're messing with your money, because that's when mistakes starts to happen. That's when you start to be like, oh, why am I even doing all this? Anxiety starts to take you off your track. And I fell into that a couple of times when I had too many accounts open up, when I was stretching myself too long. So you have to make it simple.
But would you think if they got multiple accounts, get those multiple savings accounts, if they can manage them?
Yes, if they can manage them, yes. And see, that's why, everybody work different ways. So, like, if you want to have different savings accounts, you can do that. Yeah, definitely. I just know, like, for me, like, just having my emergency fund right here, having my brokerage, right here, and then having, like, my expense fund right here, that I'm good. Yeah, so that simplicity. That's why I really want, like, all together for financial literacy, is that simplicity. And I know where everything is going. I don't have to, like, scrounge throughout all these different accounts and stuff like that. And talking about accounts, actually, with this 50-30-20 also, the goal with it is to have different accounts. Not too many accounts, but the goal is to have different accounts, because, normally, because we didn't learn, financial literacy, not just African Americans, but all Americans in general, they didn't teach that the best way, right, throughout high school. We all just have all our money stacked up in a checking account, at whatever bank that don't give us good interest, or into a savings account. We just have all this money stacked up, right? And we're just looking at it. Like, we're like, oh my gosh, that's that's $10,000 I'm not using. Oh my gosh, that's $20,000 I'm not using. It's just stacking up, right? And then we get into that mental mind frame, like, yo, we need to spend this on something. We need to use this. So, and I used to be in that habit, right? I used to be like, oh my gosh, I have all this money now, right? I have all this money, right? I can use this now, right? I'm rich now, right? I can use this, right? I can spread this. But then right in the snap, just because all that money was in one account, I can blow that within a week, So the theory that I built for myself is to have all these different accounts. So I have an account where I get paid, and then I allocate it towards my emergency fund, then I allocate it towards my expense fund, and then I allocate it towards my brokerage, because you want your money to be spread out, right? You don't want to be too spread. You don't want to have like 10 accounts. But for me, I keep it simple. I keep it to like 3 to 4 accounts. That's all I want. That's simplicity, no anxiety. So that's why I recommend for people. Definitely if you're first starting out on financial, literacy and building that budget, you don't want to deal with anxiety, because even from the past, even before your budget, you already dealt with too much anxiety. This is why you're looking into a budget, So you don't want to deal with that when you're on that task of building, wealth, building generational wealth. So yeah.
Now, they say banks are in it to make money. Should Black people bank more with credit unions?
Yes. I love that you asked that. So with my expense fund, that's where I put my own expense fund at, right? So all the money that I'm paying for, like bills or like eating out, entertainment, I put that with a credit union. And the only reason why I do that is because when you go to a credit union, it's smaller than a Bank of America, Wells Fargo, a JP Morgan, you know what I'm saying? And the reason why it's good to go to a credit union and why it's good that it's small is because you can make relationships in there, right? So think about this. If you're about to go out and, get a loan for a house or for a school or for a car, would you rather go to the predatory Bank of America, the predatory Wells Fargo, the predatory JP Morgan, or would you rather go to the local credit union that knows everybody in your community, knows, they know who you are, they know who your mom and dad is, because that's how my credit union is. They know who my dad is and stuff like that, and my mom is. So that's why I pick credit unions. And also they have a greater interest rate in comparison to Bank of America, the Wells Fargo, the JP Morgan.
They got a more competitive interest rate?
They got, way more competitive. So at a credit union, you can get a 0.06%, right? APY, right? So that's annually. So, but for, Wells Fargo, for example, you might get a 0.006, percent, or maybe you might get a 0.03%, or something even smaller, right? So, and when you divide that by 12, that's an even smaller number per month. So would you rather bank at the credit union that might give you a little bit more money a little bit more interest on your money, or would you bank at the predatory bank that owns almost everything, that has to do with lending and spending and try to put down the average American consumer? So yeah, that's really my thesis with like banking. I would just say just go to a credit union, or now again with African Americans, we're building our own banks now. So I don't know any specifically, but I know Killer Mike, he's a shareholder in a bank, and I haven't banked with them yet, but I know they're FDIC insured, and I would definitely look into banking with them. If you want to keep if you want to keep the money within the Black community and stuff, I would definitely bank with them.
Do you think Black parents should open up their children IRAs?
Yes. Well, IRAs. Yes, a Roth IRA, not a traditional IRA. So the reason I say that is because with a Roth IRA, the age limit on that is 59 and a half, right? For a traditional, I believe you can't take out of it till you're 64, something like that. So you're giving your children leeway with that. But not even just a Roth IRA. Oh, well, also with traditional, I'm sorry. So with the traditional, that's before tax, right? So they're going to take away from your check, right? They're going to take away from the net income of what you're bringing into the house, right? But for a Roth, that's after tax, right? So then after you get the money for your job or your business or whatever, then you could just allocate that 20%, that 30%, that 50%, whatever you want to put into that Roth IRA for your children. So then you can build, and then once you're in a Roth IRA, then, you don't just put in a Roth IRA. You have to buy stocks, within that Roth IRA. You know what I'm saying? Because I have a Roth IRA. That's the first account that I started with once I was, February 3rd, 2018. I started with a Roth IRA, and I bought, I think I bought some ETF, some exchange traded fund, right?
You don't have an IRA when you're what, 19?
Yes. Yeah. I didn't. I forgot. I forgot all about that. Yeah. I still have that to this day. I don't contribute as much because, I'm not so focused on retirement. I'm focused on like what I can build now, because right now in America, there's this thing with retirement where, is it really retirement, or is it just people that's leaving their main career job and just going to a smaller job? You know what I'm saying? So I don't want to get, into that rat race, because some people are putting so much money into a Roth IRA to where that when they get it, when they're 59 and a half or whatever, like, it's just like what's going to be the inflation at that time? Because right now inflation's running at a higher rate than ever before. It's at 5% year over year, and that's ridiculous. And now you have to find an investment that can beat that 5%. And just to think about where is it going to be in the future, because we print all this money. But I'm not going to get into all that, right? I'm not going to get into that right now, right? Because you just asked about what should parents do for the kids. So you can do a Roth IRA, or you can do what I just found, actually. I never messed with this account before. You can open a UGMA account or a UTMA. And actually, I'm about to search this up right quick. I have it in my notes. Yes. Okay. Yeah. So you can invest it to a UGMA or a UTMA account. So, we heard of 529 plans. That's for, if the parent wants to invest for the children's money, for the children's future, with their own money and stuff, for college. 529 plans is only for college. So, and, if you try to use it for anything else, like what if your child say, I don't want to go to college. I don't want to go to trade school. Like I want to be an entrepreneur. Then you can't, you can only use that 529 for college, or you might, have to, when you take it out, you're going to take off fees from it, from that money that you just built up over time for your child. So you don't want to run into that, you don't want to have that risk, right, in the future. So a UGMA, UTMA, that gives you that leeway with that risk. So if you invest into a UGMA or UTMA account, you will have that same tax advantage of what you're doing with a 529 and what you're doing with a Roth IRA, but you don't have to put it towards college. You don't have to, You know, you don't have to wait till you're 59 and a half, you know, for a Roth IRA. When your child turns 18, or maybe when they turn even 17, I haven't looked that much into it yet. So you know, look into the research. But UGMA, UTMA, that I feel like that's what's going to benefit our children the most for generational wealth. Because again, you get the same tax advantage, and you can put art into a UTMA. You can put real estate into a UTMA. You can't do that at a UGMA. Only in a UGMA, you can only do that with stocks. And that's the most knowledge I have with that for right now. But best believe, you know, when I have, you know, my child and everything, best believe I'm opening up that UGMA, that UTMA, and I'm investing heavily into that because I want them to have a better childhood than me. And I feel like that's the mindset everybody should have when going into financial literacy and investing.
Now, Sherlock, you often post advice
Yeah.
for people in their 20s when it comes to money. Where can they see that advice at on your social media?
So, I mean, you know, just follow me on chillaxsb, you know, Instagram. I don't use Twitter because I feel like Twitter is just people
90% BS?
Yeah, people just talking about things that they haven't did yet. They're just voicing, and nothing's wrong with voicing your opinion, of course, but it's like who are you doing it for? Are you doing it for yourself, or are you doing it so you can get retweets and stuff like that? And like also going into the structure of social media, people get so stuck on Twitter. There's just so much. I don't use Twitter, so I just use Instagram. I don't really use Facebook, you know, that's for family. So just follow me on Instagram, chillaxsb. And I post stuff on my stories, you know, daily, you know, whatever I see. But I am thinking about, you know, starting my own type of series. I know last year I did Learn and Grow with Locke. That was only part one. I was talking about budgeting and like my own financial theory on how I, you know, built my own way into financial literacy. You know, nobody did it teach me financial literacy. I had to do it on my own, had to look into YouTube, had to read books, things of that nature. So yeah, I am thinking about revamping that Learn and Grow with Locke. So stay tuned. Stay tuned for that.
Thank you for joining us today, Sherlock.
You already know.